Welcome back to another Stock Market Open live stream. This morning we have, some stocks once again in the green, specifically Intel this morning. A lot of talk circulating on Intel about that plant they've got going into Israel. This at least commitment to one in Israel. I have to say, I was a little disappointed with how little of tax credits they were getting. Now, don't get me wrong, this idea that you can build a $25 billion plant and get $3.2 billion in credits is fantastic. But I was thinking they were going to get closer to like 25 to 30% in credits from wherever they ended up going. They ended up getting 12.8% here. So I have to say, little surprised, even though a lot of people were jumping up and down on this announcement. I have to say I was a little surprised they didn't end up getting a better deal, depending on which country they ended up going to. Maybe they are. I personally, I wonder if there's more to this than meets the eye. That maybe there's some additional U.S. government kind of like hey, we'll match them. Like, that wouldn't surprise me that there's something else going on here, but that might just be my suspicion here, so I could be wrong about that. Anyway, then we did unfortunately have a strike against one of our U.S. bases in Iraq, which has frequently been targeted by drone attacks, rocket attacks, miscellaneous small arms fire attacks. And this attack over the last 10 hours here did end up injuring critically a U.S. service member, which led to retaliatory airstrikes by the United States on specific targets, specifically the Iraqi branch of Hezbollah. The Iraqi branch is called Kataib. I'm definitely not sure if I'm pronouncing that correctly, but it's unfortunate, but a lot of people are going to turn that into concerns over, does this sort of escalation mean the U.S. has to go to war? It's very important to remember that these sorts of attacks, unfortunately, have happened quite frequently. We're probably somewhere at about 150 attacks, at least 100, but likely up to about now after what's going on in Israel, probably around 100 attacks on U.S. service members or bases in the Middle East since we left Afghanistan. And so there are a lot of people on one side that argue, okay, well, because we're not there anymore, we're not local in the region anymore, we are getting basically attacked more frequently without response, potentially. In fact, out of the first 76 times that we were attacked, the United States responded 3 times. So the U.S. does have a long history of being somewhere, getting attacked, and then not responding, mostly for the desire of preventing an escalation of essentially lighting the tinderbox. You have to think about anytime you're in a war-torn region like the Middle East, things are just a disaster in one area just leads to more disasters. I mean, consider the attack on Israel by Hamas led to attacks from the north by Lebanese Hezbollah, which then triggered Yemenis Houthis to attack various different U.S.-related targets. Specifically now, you have attacks on the Red Sea, which, of course, in case you haven't heard, we did see that the U.S. has deployed. Well, we already knew the U.S. has deployed its warships to the region, but more importantly so, we know that the Red Sea is now expecting some shipments to recur. Take a look at this. We wrote on Christmas Eve at 8:34 p.m. On December 21st, we predicted stability in the Red Sea would arrive, allowing shipments to resume once U.S. forces arrived to provide covered escorts. You know, there was a lot of, and I covered this on HouseHack, there was a lot of drama on Twitter about people saying, other countries are pulling out of Operation Prosperity Garden, and they're not going to help us. We're screwed. Biden's getting left behind by other countries or whatever. I didn't really care personally to get involved in the politics of this. I cared more from the angle of, bro, we don't need anybody else. Like, let's be real. We don't need anybody else. Let's not rely on anybody else. And what we did is we called everything else bonus. That's what we suggested. In fact, you can see that right here. When you click on this, it goes down to the 21st. And I literally wrote right here, I suspect stability, this is on HouseHack, by the way. I suspect stability will arrive within the next week as American warships begin escorting cargo ships, likely en masse starting around Christmas. It takes time for U.S. warships to arrive. In other words, Biden could theoretically use military funding to prevent a prolonged rise in inflation here. And he was almost certainly going to do that. So this isn't like crystal ball. It's, in my opinion, quite frankly, just obvious. Anyway, so the good news, though, is that now Maersk is reporting that it's preparing to resume shipments through the Red Sea with U.S. support. Quote, we are working on plans for our first vessels to make transit again and for this to happen as soon as operationally possible, as they were quoted on Christmas Eve in discussing the resumption of shipments. What is really interesting, that, again, I don't want to come across as like bagging on Twitter or whatever, but we just have to be careful. Like, so that gets very sensationalized very quickly into one political direction. And my goal is just to provide, here's just fact, and then let's just move on. One thing about fact specifically that I think is very interesting is that Houthis are sending us drones and attacking us with drones that cost about $2,000. So these are a little bit more than the sort of DJI drones that we're kind of used to. These are larger drones, and they can carry a little bit more of a payload. And by payload, I mean, maybe a little DJI can carry an F1 grenade, but a larger $2,000 drone might be able to carry some more packages of C4 or other explosives. So these drones can cost around $2.1 million in a rocket alone to take down. For example, the Block 4 Tomahawk missile pictured here is a very common missile launched from U.S. destroyers or other naval vessels. And something that is really being pushed for right now, especially as these drone attacks become more common against the U.S., is pushing for directed energy beams or potentially electromagnetic pulse weapons. For example, a directed energy beam, at least according to the Missile Defense Advocacy Alliance, which probably just wants to make money selling either information or military goods and equipment, suggests that directed energy beams could cost as little as $3.5 per, that's supposed to say pulse. But anyway, the problem with these is you have to deploy an extremely expensive EMP device or directed energy device to be able to actually pull that off. So you've got to invest a lot of money in basically the cannons that allow you to use these weapons, which is true for missile launchers and otherwise as well. So anyway, point is, expect more of a discussion. There we go, fix. Expect more of a discussion around exactly that coming up. So, and I think the attack that you see here will probably escalate the consideration into these. Somebody here says, "You mean the one they used in Hawaii?" Well, yeah, I know there's speculation about that. I'm not going to get into those theses, but this is more of what I'm talking about would be more of like here, like Raytheon has YouTube video examples of these. I'll give you a quick little look at these. But again, expect discussions to advance around these specifically. So let's go to like Raytheon, laser weapon. Here we go. Yeah, these things are, at least they appear pretty incredible. So take a look at this. So here's a Raytheon video. See, look at this. Raytheon's high energy lasers. And, I mean, you could put these on like a little Polaris. Look at that sucker. And these things, they have their little radar. And, I mean, it looks like they've got a bunch of different cameras here. Radar, probably LiDAR, and otherwise. Look at that. Target the drone. Give it a little boopsie-doopsies. And there it is. Here we go. Engagement. Bye-bye. So that's an example versus a DJI here. And then they have, this looks like a real example, whereas I think towards, do they have it in this one? No, they don't. But in other videos that Raytheon's released, they have some mock-ups of how these could end up working in taking down multiple targets at the same time. Yeah, here, take a look at this. So here's an example of some form of artillery coming towards maybe a U.S. base or whatever this might be. Here's your little laser that just decides to wake up. It tracks all of the various different targets. Bye-bye. Bye, rockets. $3.50 a time. You know, I mean... counterattack. Yeah. If that's the kind... And here it is mobile as well. If this is the kind of stuff that can end up defending U.S. lives... I mean, look at all these drones here. Then it's a fantastic tool. You know, again, it's got to work, it's got to be deployed, but look at that. I mean, this is like from a video game, man. That's wild. Yeah. So, looks like they're going to show it against a helicopter here. We'll give you the thick beam. Shows a helicopter crashing. I don't know. That all seems like going into the future here, that's for sure. But anyway, so that's an example of what these energy-related weapons could look like. You know, actually what I might do is might link some of those videos on YouTube because people might find those somewhat interesting. So I'll go ahead and do that. But anyway, yeah, let's see here. What do we got? Let's see. Okay. Let's go hop on over and see what some of the news is this morning. So what do we have over here? In 2023, you know, you had a big surprise to the downside in 22. A lot of people caught off on sides there. And then you had a similar thing in reverse this year, really. And I think you have to understand so much of that rally this year was really instigated not by dramatically accelerating fundamentals so much as it was, wow, well, there's not a recession. And by the way, there was a massive positioning off sides. And I think that, you tend to think of positioning mismatches as things that play out in a couple of days, a couple of weeks, maybe a month or two. This was a whole year of it. And I think a lot of big allocators were really just sort of playing catch up here in the second half of the year because they were probably overweight bonds and underweight equities from last winter. As we get into 2024, I think we are that positioning mismatch is going to be largely behind us, and I think it's going to be much less of a factor there. There's always going to be positioning.
Yeah, I actually don't disagree with this person here. This idea that, oh yeah, we might end up in a situation where we've we got a lot of our percentage allocation realigned. In that you don't end up getting this. Oh no, we have too little stocks like you did in early 2023. Now the flip side of that is you have a lot of cash on the sidelines right now, which people suggest could make its way into the stock market, bond market, and mortgage-backed securities. Keep in mind, it doesn't all have to go into stocks. So, those are important considerations. All right, let's keep listening here.
I think, most of that has been sort of processed. I think what is so important, though, in this discussion is that during 2020 and 2021 and 23, there was this emergence of longer-term structural trends that had nothing to do with COVID, but it had to do with energy transition, it had to do with deglobalization, had to do with, you were talking about commodities and oil prices earlier, and I do think that there's a different condition emerging with higher geopolitical risks, and also just, commodity producers being more less given to supply expansion. You were talking about oil, but look at iron ore is up 50% in 3 months. Look at copper prices.
That is true. Iron had this pretty wild spike, and iron is really considered a build commodity. You see a lot of iron movements when people believe that China is all of a sudden going to develop substantially more, especially, or it could be a speculation on their real estate market picking up. But in this case, it appears to be ex-China demand that actually is potentially picking up. So here is a note that suggests higher scrap utilization and lower steel net exports mean that China's pig iron output and ore imports are unlikely to exceed market expectations again in 2024. It could stay flat in 24. Okay, fine regarding China. Iron ore demand may slow on rising captive output, scrap, whatever. I'm trying, let me see here. Modest, okay, here it is. Excuse me. Iron ore imports outside of China may rebound 3% in 2024 amid improved outlook for steel globally. Remember, steel is made from iron in blast furnace at higher temperatures than just iron, like refined iron. But anyway, developed and developing Asian countries could in turn increase steel output, boosted by China's improving demand outlook. So they're making this argument that you could see iron move up as a trade because of rebounding demand for iron and steel globally, but also potentially aligning with a bottom in China. It's an idea. So we'll see. Another thing that I thought was very interesting is there's this, look at this piece here. Bloomberg ran this. It's a Fed's pivot is forcing stock market skeptics to become believers. And if you go in over here, look at this. Doesn't this name seem familiar? Morgan Stanley's Mike Wilson, who's been one of the biggest pessimists among sell-side strategists, said Monday that the central bank's shifts last week is a bullish outcome for stocks. Piper Sandler's Kantrovitz, who's held the most gloom S&P 500 outlook this year, issued a mea culpa and now says the rally can continue and the breadth of the advance is likely to improve. Now, there could potentially be a downside of this. The last time we had this sort of mea culpa or flip-flop, it ended up being in July, and the stock market ended up falling after that. So it's not generally good to see your bears, your resident bears, flip-flop. So that's going to be something I pay attention to. Anyway, listen a little bit more over here. What is this?
If you're watching...
Astro's okay. Commercial. Ha ha ha. Here we go.
Certainly the tie-up of Comcast and Discovery seems like that would trigger red flags everywhere. I mean, what role does regulatory environment play in what we're likely to see?
That's a really good question, Contessa. And I think there's this thought that Paramount, one reason why those assets could be in play first or perhaps sort of easier.
Media talking boring. All right. So we do have, it looks like at the moment when we go to CoinMarketCap and kind of take a look at BTC, we see a little bit of a pullback here, down about 0.43 basis points on Bitcoin in the last week. That actually compares to Binance Coin being back over 300 again, Ethereum up 83 basis points over the week, Solana up 54%. Over the last 7 days. So you've got a little bit of this explosion on some of the alts here. 4% in the last 7 days on Cardano. Avalanche up 12%. Polkadot up 33%. All this within the last 7 days here. So a lot of euphoria and excitement over some of the various different crypto assets. But I mean, Solana, for example, consider this. I mean, you went from $20 in September, October. I mean, November 1st, you were like $41. You're at $115 right now. So nice, nice inflow into Solana there. This is, this is creating some enthusiasm in the crypto market again for finding the, all right, what's going to be the next coin or token to run? Yeah.
Pieces on the chessboard that Julia just outlined. But there was a Moffett-Nathanson note that last week described the need for media M&A as these desperate times for media companies are leading them to explore desperate measures. So you see that happening specifically with the Warner Brothers Paramount tie-up as kind of falling into that category. Why is that? And if these mergers do ultimately take place, does scale achieve what they're hoping to kind of solve for in these desperate times?
Well, thanks for having me. Happy holidays. I think the answer to that question is, in the short term, this is a very tough thing to have these companies engage in. They'd be doubling down in decline. They have struggling core legacy businesses. The streaming businesses aren't doing well. And having said that, the status quo is not a good answer, so they need a better answer. And the question is, are these possible merger a better answer? Certainly, there's a ton of cost synergy here between Warner Brothers Discovery and Paramount. There'd be a reason for Warner Brothers to want to strengthen its sports play. One, getting a broadcast network. Two, getting the NFL rights. There's certainly value in killing one of these streaming services, namely the Paramount streaming service, and put it together into a single streaming service with HBO and have something.
I don't know, the media stuff is boring. Let's see what else we got.
Thank you so much. So appreciate you coming on with us again. The U.S. consumer, they do like to go out and shop, me included. How are we doing? What are we hearing about the day after Christmas shopping? Are you getting any early reads?
Yes, we just got an early read within the past hour. MasterCard Spending Pulse came out with their data from November 1st through December 24th. Holiday season sales up 3.1%, slightly below their forecast of 3.7%. And keep in mind, it goes through December 24th. Many of the other forecasters out there either go through December or through January. That's coming in at the lower end of the 3 to 5% range. But as you mentioned earlier, it's still up. Consumers are still spending. We've got gift cards that need to be redeemed. And overall, some of the interesting data that came out of it is the fact that apparel was up, online was stronger than in-store sales, jewelry was down, and restaurants that focus on experience, you saw restaurants and grocery being up.
Yeah, I'm just coming back from an overseas trip, and that's what I did. I ate out a lot and enjoyed it rather than shopping. But having said this, Dana, you're the expert. You've seen the cycles, coming off the pandemic. What do those numbers tell you about the health of the U.S. consumer?
I think the U.S. consumer is healthy. I think they're being very cautious in their spending. And the change that I've seen, even in the past year, we've seen a moderation in spending across all income levels. From high end to low end, that spending is moderated with much more cautious and discerning consumer. You think about some of the things that have changed. The luxury goods spend is lower than what it has been. You're seeing apparel being spend very discerning. Jewelry's been weak. It's expected that in 2024, jewelry will have more of an uplift, given we'll get back to more normalization in engagements post-COVID. But for the most part, it's very discerning spend, and the retailers planned appropriately. Discounts and promotions weren't as severe as they had been pre-pandemic.
Okay.
Dana, good to see you this morning. It's interesting that the fresh...
Yeah, I'm reading through that spending pulse right now. It's U.S. Retail sales ex auto increased 3.1% year over year, from November 1 to December 24th. Now, that's probably in line with inflation, so it's probably flat inflation adjusted here. Let's listen to some more commentary on that.
Hedonistic behavior that can cause us a problem in the near term, or do you just look through it and go, actually, they're fully employed, we've got full employment, things are good, stop worrying about the credit card balances and the buy now, pay later?
I think overall, one of the things about the U.S. consumer, they continue to exhibit strength. I would have thought that as we went through this year, you would have had a greater moderation in spend from the lower and middle income. But exactly what you just mentioned is the strength of employment, inflation coming down, are giving them the ability to spend. They may not be spending as much as they did 2 years ago, given the stimulus that everyone benefited from, but they're still spending more than you may have thought. And now the lower rates, the stronger job market, that if you want a job, you can get a job, and that your wages are going up. And frankly, wage growth is pretty substantial with inflation easing. I think just the U.S. consumer is an optimistic consumer, even though the rate of spend is not as great as it was in 21 and even in 22 in many instances.
Dina, it's really interesting to hear you say that because, of course, one of the big questions has been how do you have the Fed hiking rates by 500 basis points without too much pain? And it sounds like when it's coming to that consumer spend, that can actually continue here, that actually maybe we did get through this tightening cycle without that sort of associated pain that was widely expected.
It does feel that way. I mean, you certainly have had categories that have been weak. You take a look at housing and things related to the home. That's been weak. You look at luxury goods, which has gotten weaker. But one of the data points to watch is, while year over year it could be weak, when you look back to 2019 to today, even luxury goods sales are up 50% plus. So that consumer, if they want a job, can get a job. But I think also one of the toughest things for retailers, we're seeing more confidence in their ability to project profits than sales. I think you're going to continue to see retailers being very cautious on sales growth. I think we don't have the tourism that we've had in the past, and that the orders that many of the wholesale accounts or department stores are placing continue to be cautious with vendors. I think that no one's expecting a rip-roaring retail environment go forward.
And,
yeah, I actually think that's a great way to put it. And just so you know, I have that spending pulse data here on HouseHack.com. You could actually just click on the little link here and you'll get the whole spending pulse PDF if you want the whole thing. I try to do that as much as possible, just kind of throw up the actual data that we've got, so that way you can look at it yourself. So that's on ehack.com. We've also got a link to that story on Mike Wilson suggesting that stocks have the green light to run higher after the Fed pivot. Yeah, take a look at the actual categories here. So total retail only up roughly what inflation was up. However, e-commerce was actually up 6.2%. I was actually a little surprised to see e-commerce up 6.2%, especially since we have seen some warnings from e-commerce. For example, Nike just warned that, well, let's take a look. Go type in Nike over here, and then, oh, look, you can see what Nike says. See, that's how convenient eHack is. You just Command F, and then you got Nike. And Nike reported that they actually saw, here it is, we are seeing indications of a more cautious consumer behavior around the world. And they suggested that they were seeing softness in digital trends relative to some of the other aspects of their business. So I was somewhat surprised to see retail sales online up at these levels, following this Pulse report here, and following Nike's report.
Used to be a share gainer both with grocery and with goods.
Did you want to say something about Birkenstock, Katie?
I was going to say they're not the most aesthetically pleasing shoes. I'll just leave it at that.
Well, let's put it this way. Do you
I know
find
somewhere
something
it's
very
14
aesthetic?
pairs.
Yeah. Hey, listen, Barbie wore 'em.
That's
Pink
true.
ones. Just going to say, Katie Greifeld.
That was after she left Barbie World, though.
Okay, so even better.
Yeah, that's true. That's true.
We've gone into Barbie world. Okay.
Dana Telsey, I agree. Listen, the runways, right? They end up putting Birkenstocks, Crocs, like they go everywhere. Dana Telsey, you're a gem of Telsey Advisor Group. Thank you so much. Happy holidays and Happy New Year to you. You know, I was looking at the S&P Composite 1500 Retailing Index. It's up 41% this year. I know it lops and drops a lot into that index, but nonetheless.
I mean, as Dana was saying, I mean, what a strange economic cycle this has been. You haven't seen that lower spend drop out in the way that was expected. Obviously, luxury has been resilient as well. Just all over, it feels like this consumer, the hedonism of the U.S. consumer, it's unbreakable.
Listen, the hedonism of the rich is what you want to keep an eye on, because companies like Richemont, there's a very well-known Jan Rupert who runs it.
All right, let's pull off here and let's see what else we got to cover. So, all right. So, I've been reading a lot about housing as well. A lot of fears that people won't get the chance to buy a dip on housing. Other people fear that there'll be a crash in housing. Although more people believe that the big question will be what happens with inventory this spring. And I've mentioned it many times before on the channel. If inventory comes in really high because everybody who's been waiting to sell starts thinking, oh, rates are going down, now people will start paying up again. Is it possible that if too many people think that, you actually end up getting some softness in pricing? So who knows? I think being patient through now and then will be very rewarded, but we'll see. And I've mentioned this before as well. I don't see us going back to the insanity that we saw of appreciation in January to even say July of 2021. That was an insane period of time where a lot of inflation dollars were chasing very, very few properties. Anyway, as you can see, this is what S&P futures looked like when futures or the pre-market trading opened up a little bit ago here. So up about 14 basis points here. NASDAQ, same thing. Acting like we're getting a little bit of a bleed there into in the pre-market, but then again, it's just pre-market here. Here's Tesla up about 73 bips, Enphase up about 45 in the pre-market. Probably the biggest mover in the pre-market is actually Intel. Let me see here. Yeah, Intel's up 2.2% on that Israel deal, but NEO actually outperforming a little bit more with a 4.1% increase right there with DRAC. Flipping over to the negative side, you've got Zim, which has been pretty volatile, down about 6.7%, probably because of the resumption of some trade through the Red Sea and less of that fear in the Red Sea than some were starting to try to price into this stock. That could actually, makes me wonder if this could actually end up being a good short. If you believe that this Red Sea issue will resolve itself, is it possible that Zim could be a good short today? I actually think there's a good possibility of that. So we'll see. That'll be something to pay attention to today. I'm kind of tempted to write that one down. I've made some money shorting them before. That doesn't mean you're gonna make money on them again. But I don't think it hurts to be a little or pay attention to some of these geopolitical things, mostly because people have this tendency to really believe everything's going to be so much worse than it ends up being. And I think that's because it makes really good news and sort of shareable negativity, and it's unfortunate, but negative news, we all know, spreads way faster than positive news. But anyway, 5-year break-evens right now sitting at about 2.19. If I go to the 5-year forward break-even, which would be the next 5 years thereafter, these are sort of your longer-run expectations. We're sitting about 2.17. That's really interesting because the 5-year forward has been higher pretty much the entire cycle of the current regime, and it's kind of wild that all of a sudden you're seeing the 5-year forward lower than the 5-year out. So that's sort of a unique twist on the phrase inversion, I suppose. different type of inversion, we might call it. So we'll pay attention to this. It's 6 now. Let's see. That means Jimbo must be in, or Sarah's wrapping up.
Take a look at futures.
Or is it her instead of Jimbo?
Continues after 8 straight weeks.
That's okay with me.
Strong here, up to 62 points on the Dow. NASDAQ pointing to an upstart as well, 24 points. S&P up 8 in the early action. Our roadmap for the hour is going to begin with the market rally. Major indices in the midst of an 8-week win streak. Also ahead, shipping giant Maersk preparing to resume operations in the Red Sea after attacks by rebels in Yemen.
Plus, a setback for Apple. The White House declining to veto a U.S. trade tribunal's decision to ban imports of the company's watches.
We begin, though, with the markets as we kick off a holiday-shortened week. It has been amazing to see the resilience and the strength of this rally, Scott. Even, the strategists all put out their S&P year-end targets for 2024, a month ago? We're close to that.
Yeah, they have to throw those out in the garbage because of what we've done since November 1st. It's pretty stunning. Dow's up 13% since November 1st. S&P's up 13.5%. Now we're going to talk about all-time high watch because we're going to open above the all-time closing high for the S&P 500, which was 47.96. So keep an eye there as the futures look positive. The intraday all-time high is 48.18. But the run since November the 1st has been nothing short of stunning.
And it's really Fed-fueled, right? And you've seen it in the bond market, too. The rally in the bond market, 100 basis point move lower in the 10-year yield. We're also breaching all the targets for next year that the strategists are putting in place. They think the 10-year is going to end at 4%. Guess what? We're below that number now at 3.9%.
Yup.
Which makes you wonder about how much is being front-loaded.
Pulled forward.
For next year. If next year is all going to be about rate cuts and normalizing policy from the Fed and the ECB and the Bank of England, well, the market's done a lot of work toward pricing in now 6 cuts for next year.
Especially when you consider that so many of the lagging areas of the market are the ones that have run so much since November. So if you're thinking, well, you're going to go into a new year, there's a lot of optimism, let's chase some of these underperforming areas. Well, they're not really underperforming anymore. I mentioned what's happened since November 1st. Real estate's up 20.5%. The financials, which had done next to nothing for much of the year, up 15.5%, just over, 7-8 weeks.
Russell's had a big comeback, too. Everyone thought Russell small caps, play that because that's lagged all year. Now, it's still, up much less than, say, technology, but the chart looks like this. It's a V chart. I'll come all the way back.
22% since November 1st.
There you go.
It's been remarkable, and it feels like so much of that happened so fast. Are there really going to be chasers left to get into some of those underperforming areas of the market? I think that's going to be a big question. We'll have to find out whether earnings are going to deliver the goods.
Absolutely. I think also if you look at sentiment.
Yeah, that makes me nervous.
Given the bullishness, you can check the AAII, individual sentiment readings. Bears going into hibernation. I have a great chart that looks at the fact that it's the fewest amount of bears now in the market since 2018. They're leaving because everybody's jumping on board the rally. Now, does that set us up for some sort of correction in the new year? Because it's kind of a contrary indicator. There's the fewest bear chart since 2018. You might think, people are getting a little too bulled up here.
That's what Ed Yardeni is talking about that today. He says, the only thing we have to fear is that we have nothing to fear. Right? Because everybody has suddenly gotten on the same side of the boat. Goldman had a trading note today that said there are no caution signs out there, which means maybe take caution.
That's a problem. But there are things to fear, right? I mean, okay, first of all, 2024, I think I read this in The Economist, is the most elections ever. We have the U.S. election. We have a U.K. election. We have some geopolitical hotspots like Pakistan with an election, India with an election, commodity exporters like Indonesia with an election. Just the source of volatility, no question about it. I think the U.S. is the big one there. There is also this risk that the economy slows down too much. Right now, we're in the sweet spot of a soft landing, and the markets embraced it. The markets cheered the fact that inflation is your friend. It continues to disinflate and even deflate in some parts of the economy. Market feels good about that. But can we really hang on to a soft landing? Can the Fed really stick it? We are seeing signs of softness in parts of the industrial economy. I think Nike's warning was stock sold off 12%. on Friday when they said they're seeing a different kind of consumer profile. And it wasn't just in the U.S., it was all around the world. So I think signs about to your point, earnings and the economic softness is certainly a risk factor that the market is not pricing in, recession or anything slower than, say, just a minor slowdown.
Though if you're waiting for the consumer to crumble, you're still not getting many signs of it. The early data from holiday spending was up 3.1%, according to MasterCard. Now, you may be, increasing your credit card balance and delinquencies.
It's just inflation. That economist piece is interesting. It's really what it was a measure of how many people are in countries with elections. So it was really a population-adjusted chart of people in countries with an election that year, and how 2024, how would you say this, has the most people in countries with elections year ever. Whatever that might mean. I'll pull that chart up here in a moment I guess that's a mouthful. So we'll get that up in just a moment.
That we got a good number. E-commerce was another big driver, up 6%. In-store was only 2%. Two categories were lower, which I thought were notable. Electronics and jewelry were actually down in spending.
Yeah, this is what we referred to earlier, the MasterCard Spending Pulse, which we threw up on HouseHack. Where we were kind of curious how could e-commerce be up? I mean, I suppose it's worth remembering the Spending Pulse stuff. It is a year-over-year comparison. So e-commerce could be up 6.3%. But wait a minute. These are year-over-year numbers. Nike gave us a warning that is more probably important for us to consider now. So I don't like taking this data and suggesting that, this is definitely a sign that it's, the time is here to go all in on Etsy or whatever online retailer it might be. Mostly because, wait a minute, is Nike giving us a more realistic near-term warning? Whereas these are year-over-year numbers. So something to remember here, too.
To go travel and spend money on airfare and hotels and everything else. But these stocks have had an incredible run of late as this appetite remains for whatever experience you want to have, whether it's, the concert goers, Beyonce, Taylor Swift, whether it's traveling, Expedia, and those types of stocks doing well. The airlines have had a really good go of it of late,
Don't forget
too.
the cruises. Best stocks of the year, Royal Caribbean and Carnival. They're in the top 10 of the S&P 500 in terms of year-to-date performance, up 160% for Royal Caribbean. Carnival Cruise Lines up 134%. They just had earnings last week. We talked to the CEO, Josh Weinstein. He continues to say there are no signs of decreased demand. What about the recession? What about the slowdown? What about the pent-up demand wearing off? They're just not seeing it. Now, cruises were a little late on the whole post-pandemic travel rebound, but still, the amount of demand and what people are paying on prices, it continues to be a priority.
I just keep thinking of all these other areas where there doesn't seem to be a slowdown whatsoever. It's like the Major League Baseball economy. Dodgers spend $1 billion on a couple of free agents, Ohtani, Yamamoto. Then you've got the stake in Manchester United, which goes to Ratcliffe over in the UK, the richest person in the UK, for a $6 billion valuation. It's remarkable to me where valuations of everything continue to go up. Certainly.
That's called inflation, buddy. Even the sports teams have inflated. Let's go ahead and over here. No, I don't really care about covering this because that's politics. And we're not going to talk about the college anti-Semitism drama when we're trying to cover what's going on in stocks. Zim sitting down 7.5%. I'm going to watch that one. Enphase 72 bips. I'd like to see how the volatility index trades once that gets going. Taking a look at BTC, the pullback in BTC probably wasn't that big of a deal when we actually look at, what we've got going on the fib retracements here. Holding on to that 42.2 number, probably pretty important. Anywho, so. Maybe not that big of a deal. Looking at the world interest rate probability curve, we are sitting at
3.78 as the implied Fed rate. When we get to 1 year out, that would be pricing in 6.12 cuts. Okay, that just adjusted to 6.14. I could show that as well on screen in just one moment. But this will show you the implied cuts that we're looking at for the Federal Reserve and what's being priced in by markets. Obviously, if we have less, then we'll have to unprice some of those rate cuts. You can see the way this works is at the top left is where we are right now. Yeah, and it's a little funky, but basically on the right you have number of cuts, and number of cuts sitting over here at 6.14, and then that would imply a Fed rate of about 3.8%. So again, a little funky two-sided chart here that can be a little confusing to read. So all right, very well. We'll see how that develops. I did also throw up some Tesla China numbers on ehack.com. So again, ehack's going to be where we just throw our sources, some of our most fun things, and obviously a little bit less posting during the holiday here, but hey, we're still posting about the Red Sea and otherwise. So what's notable now, though, as we're getting through the holidays here, is this is that election year chart that I promised you. It shows you 2024 is the most people in countries with elections ever. Now, personally, I don't see elections as that big of a catalyst. A lot of people do. They're like, oh my gosh, elections change everything. And a lot of people actually get really afraid to invest until elections are over. I usually love investing before elections because, I don't know, in my personal experience, I usually see asset classes do well after elections because people finally get over this idea of, oh, I'm not investing until the election's over, and then they invest. And then that's usually where you get like your euphoria because like everybody piles in after the election because they were fearful that some mega change was going to happen because there's an election. At least in America, I don't know how much massive change you really get in an election. It's not like you're getting a new government. You're still getting a very slow moving Congress and judicial system, and that actually breeds a lot of stability. So it's actually a good thing. I've mentioned this many times before. I think that founding fathers were just brilliant, quite frankly, about how they were able to pull off this so forward-looking plan for or system of government that suggests, you all will only basically change something when you need to. It's kind of interesting. So then we've got a posted here from Tesla Chan on Twitter. Tesla China insured units for the week leading into Christmas Eve coming in at 18,500. That's up about 38% year over year and 1.09% week on week. Pretty good. And then we have our spending pulse data over here that I touched on. Threw in a little note about Nike's numbers being more nuanced to Q1, Q4. Again, when you click on Nike's warning right here, it brings you down here. Remember what Nike said, just to remind you, they talked about Q1 potentially being slightly negative. Calendar Q1 being slightly negative, and then Q2 being potentially slightly positive. So something to watch here as well when we consider those spending pulse numbers, which are sure to get headlines today. They are year-over-year numbers, and they're not even that great at that.
IPO Flow Show. We leave you with a hint of green for this holiday season.
Okay, let me flip over here. Brian Wright says, just checked out eHack by Meet Kevin. Dude, I love this. I'm always wanting to pick your brain. Yeah, thank you for that. Probably one of my favorite things about it, because I use it as well myself, is just the fact that, like, I could reference these older posts. Like, I've had to talk about these EMPs so many times, for example, these over here, and I just love the fact that I'm able to link back
to some of the prior times that we've talked about them. Russia, Ukraine, or the Red Sea right here. We talk about the different straits or whatever. So being able to go back to some of the other posts that I've had, I think has been incredibly useful. So, okay, good. Let's see here. Let's find what else is going on. Let's see what the suits are saying in the morning. We are 15 minutes away from the bell. Fed plot line for 2024 may reprise 2023 in terms of surprises. What? Who comes up with these titles? Bro, I don't even know what I just read. I don't know if the coffee hasn't hit or I'm too stupid to understand what that was. But it says, around this time last year, markets were betting that the Fed would raise rates by some 50 basis points around the middle of 2023 and look to unwind some of that tightening by the end of the year. As it happened, the Fed had to raise rates by twice as much and was unable to loosen policy entirely in 2023. Well, stock still did well. Interest rate traders are now factoring in plenty of policy loosening based on the conviction that inflation is now in the rearview mirror, as the U.S. economy, especially the labor market, seems to be broadly resilient. Fed estimates that it could loosen its policy 75 bips in 2024. Market obviously thinks 5 to 6 times. Yeah, there it is. Market reckons twice as much. Given the strength of the labor market, it's hard to say with great conviction that inflation will slow to 2% anytime soon. I think that's really interesting that there's this idea that, if the labor market does well, is that going to lead inflation to come, to be able to come down? I don't know that a strong labor market means you can't have falling inflation, because you might have a strong labor market where people are still employed and new businesses are risking capital on new ventures and hiring folks. That doesn't necessarily mean businesses have the appetite to raise prices, because really, in order to raise prices, you have to feel like you can raise prices above and beyond your competition. Otherwise, you get destroyed via volume. And if you get destroyed via unit volume, your net might go up with higher prices, but your sales metrics turn vastly negative. And so I think there's a real risk there. If unit volume falls more than your price hikes. So I'm not, as usual, convinced that and I've mentioned this a million times before, that A, a strong economy means more inflation, or that B, a strong jobs market means more inflation. You could actually have both of those be strong and have declining inflation, mostly because that's the point. A well-oiled economy should generate lower prices. In fact, going back to, once again, HouseHack, I thought this was very interesting. On Christmas Eve, I posted this on HouseHack here. I posted Bank of Japan. Bank of Japan continues their hopes to emerge from a low inflation environment and achieve positive wage inflation cycle. Crucial for increasing corporate profits to lead to higher income household income. Incomes, suggests the Bank of Japan. Key is whether companies will be able to reflect rising wage labor costs to prices of their goods and services. This is a translation from Japan, so it's Japanese, so it sounds a little funky. But anyway, basically here, what I translated this to is I wrote, Japan is frankly deathly afraid of deflation, because deflation creates a savers mindset. This is correct. Deflation creates a savers mindset, which slows economic growth. The Bank of Japan is frankly desperately trying to induce inflation and is hopeful companies will make enough money in their country to create some inflation. And this is where I kind of wrote this rhetorical, I'm like, could you imagine a politician saying that in America? Quote, we hope corporations make more money so they can raise prices and pay their workers more. Like the Fed, and they know this. Jerome Powell knows this. The Bank of Japan, they know this. And the Fed subtly says that if you pay close attention. Like their goal is to make sure prices don't fall too much, because then you get this deflationary doom loop. So if you're wondering, like, is the Fed rigged to try to keep prices high? Yes. And they bluntly tell you that. It's not a surprise. So that's why this idea of, we want deflation, we want prices to come down, is so misplaced.
it is very unlikely to happen absent a very dark depression, which you don't want. I know some people are like, I don't know, I don't want prices to come down. Yeah, well, you want to lose your home? And they're like, well, I'm renting. You want to lose your job and then have to downsize or move back in with mom and dad? You know, it's not good. So, anyway, all right. Let's see here what Doomburger has. As we got about 10 minutes to go to the opening. Hear nothing. Rip. Okay. No problem. No problem. I can fix it. I have fixed it in the past. I will fix it again. All right, what else is new? So we talked about Intel and that weak incentive.
When you talk to bankers across this...
That was very loud and annoying. All right, there we go. We talked about Intel and the weak incentive package, but it is an indication that I fixed it. IPO market. Oh, no. Oh, no. No? I don't have it? What the heck is going on? Yeah, whatever. I don't really care that much about the IPO market right now anyway. IPO market outlook. Yay, it's going to be better. Okay. So, all right. What do we got over here? Mom and Dad's house has nachos. Compelling. Presidents want to juice economies. Yeah, but that's every president, right? Of course every president does. That's the job. That's the job of your party, is to juice the economy. The only way forward is inflation. Guys, everywhere and all time. CBDC will just make it so much easier to make zeros go up in the background while your tokens look the same. I don't even know where to start. Like, first of all, like, you're claiming that the only way forward is inflation with zero evidence. And then now somehow you link that to CBDCs, which aren't even here. Like, and then you're concerned that they might print more tokens. Bro, they literally print dollars every day. You don't even need it to be a token. You literally don't even need it to be a token for them to print every single day. Digitally at that. So you already have digital money printing. So I don't know where you're getting with that. It's not really a well-structured argument. What's Austrian economics? It's basically what every politician doesn't want. It's kind of like trying to, it just as a quick example, Keynesians like to print their way out of problems, is the thesis, right? The thesis is that, just a quick example, a thesis might be, hey, going into a recession, print money so we can prop the economy up. Austrian might be like, let the businesses fail, default on the debt, let it collapse and burn. And the idea is that Austrian would be more of a traditional system, an economic system where, like, you don't just keep printing money. You have money with foundational currency or a foundational value that that probably deflates, frankly, over time, where your money becomes more valuable over time because there's a finite quantity of that, much like much potentially like Bitcoin or gold. Gold-backed currency reserves, very, very different than what you have with the current school of thought. Anyway, all right. So let's see here. Do you see Tesla breaking this resistance? You know, eventually Tesla will, and it'll probably be pretty glorious for Tesla. I mean, I have no idea, but yeah, it's. I don't know that it's going to be before earnings, frankly. I think you kind of need really positive earnings numbers in a really good earnings call here. I don't know if you're going to get it. October was probably the worst month in Tesla's history, is my guess. Mostly because you had the highest interest rates ever then. So, I don't know. We'll see. Yeah, I like this headline. Is OpenAI worth $100 billion? No. I covered that on eHack as well, but let's see what Sarah says. I can't because it's not working. What the hell? All right, I'll fix it. I don't understand. We literally had it. We had audio, and now we don't. And how am I gonna get the bell? Whatever.
All right, what is this? Supply chains are breaking. They'll rebuild stronger. Okay. Let's see here. Pick a single item from an array of shocks. You can see how fragile the global economic supply chains are. Yes. But combined climate change, decoupling from China, unprecedented technological development, wars, rising costs and labor shortages, and we now have an amalgam of catalysts that will change global trade forever. Okay. All right. Let's see here. The pandemic is seen as the primary cause for many disruptions over the past 4 decades. Yeah, well, this is kind of boring. Let's see what they're trying to get with this. Diversification. Oh, okay. This is a reglobalization argument. Got it. It's the idea that, don't worry, we will re-globalize supply chains, and that we don't have to be worried about supply chains breaking. Yeah, I do think that's an interesting argument, by the way. This idea of essentially we don't need to be worried about, oh, everything's going to be nearshored, everything's going to go to the U.S. and then be much more expensive. The reality is, companies are almost always going to look for where they can get the best deals for supply chains, and so they'll just rebuild wherever they need to, frankly, to limit the potential for increasing costs. I think that's why you're seeing investments in Mexico, why you're seeing investments in India and elsewhere. So taking a brief look here at the oil market, which we haven't touched on yet, is Brent sitting at about $81. So nicely moving up over here. Let's see here. That's Brent, the international blend, $81. WTI sitting at 75. Then we've got 10 years sitting at 3.9. Then you've got here are your futures across the board: Nasdaq, S&P, Dow. Slightly up here, 5 to 18 basis points. No big moves over here. Take a look at El Pre-Market, and we'll see how stocks begin to move in about 3 minutes here as we get into the open. You've got in El Pre-Market, let's take a look. Pre-market, still DWAC, NEO leading the way here. Intel up about 2%. ARM's actually done, is positive again since their IPO. I think you still have lockups coming up though, so you're gonna want to pay attention to that. If you go to the ARM IPO, what was the date of that? That was about September 14th. You should be knocking on the door here soon of your first set of lockups of 90 to 180 days. I'd have to see specifically when. I think they have lockups both 90 and 180 days, but I'm not sure about that. So that would be worth looking into, because you might still have another 3 months to go before you end up getting your lockup agreements. They have very little of that stock public. So I think there's, if you do have lockups 180 days out, there's probably still good potential for some movement as that potential sales pool expands. But then again, maybe insiders think, why sell? Markets are going up, It's always possible too. Yeah, I mean, it seems like the reason to sell now might be taking some gains, right? Trying to trim off the top a little bit going into the end of the year, trying to make your fund look a little better or whatever. People do that pretty regularly. All right. Let's see. What is this? Apple Watch import ban. Yeah. One of the things I noticed about this is Apple sold out their Apple Watch way earlier than expected. They were expecting to end sales of the Apple Watch on the 24th. And when I heard the news first, what was it, like on the 18th or whatever, about this Apple ban, my first reaction was people are going to go buy more of these watches. They're going to want to get their hands on them. And Apple sold out by the 21st, 3 days early. So I think we were right about that. I actually think it's a near-term positive probably for Apple. Anyway, we lost audio, but that's okay. I'll go ahead and be the bell for us here as we go into it. So technically the bell should be ringing right about now. Ding, 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 ding. Yay. Bell. Woo.
Go yourself.
Yeah, that's our bell
Is that
today.
clear?
All right, perfect. So looks pretty green. Green, green, green. We'll take a look at how things look on the actual board if they show it here. But anyway, in the meantime, are they going to show the board? I'll just read out some numbers here. Looks like, no. NASDAQ's up about 22 basis points. Tesla tried to spike up there. So did NVIDIA. But I'm not sure what's going on over here. Look at that. Tesla tried to spike up there. Briefly for a moment up to 255. Was up about 1%. NVIDIA tried to spike up. Although we haven't really moved on these at all. I mean, they've just been stuck on 490 and in the mid 250s there for Tesla, just stuck. Intel trying to push green a tiny bit. Coinbase nominal pullback. I mean, 84 basis point pullback on a 2.5% decline there on Bitcoin. Nominal pullback. Does look like Zim is rotating down about 8.7%. You've got Rocket Lab 5.3, Neo 3.6, SunPower up 3.8. Ooh, SunPower up 3.8. Is there news on SunPower? Let's take a peek here. SunPower. What is the power for another boring day? Says Andre here in the chat. Must be a bear. Sunrun profit outlook up here is cloudy amid residential slowdown. Well, yeah. Oh, SunPower was down like 31% last week. That's right. That's probably then just a little bit of a normal rebound here. All right. Somebody here says, anyone else hungover? Well, it sounds like somebody had a fun Christmas over here. Car market thoughts? Bubble? Well, I mean, of course, car prices should come down substantially from the insane supply chain shortage-induced prices that we saw in during the pandemic, 2021. So what I would recommend is let's look at the used vehicle index and just see what the chart's doing. It's probably just a big old bloop. Yeah, that is, I think, exactly what it is. Yep. Going back out 5 years. Let me go back out. Let me go to like 05. Oh, yeah. Yeah. I mean, I don't know if it's possible to really call it a bubble versus a normalization, like a bubble pop versus normalization. And I suppose when you get negative numbers in a row, you may as well call it a bubble pop. I don't really know if it matters what you call it. But there's no surprise. These numbers are coming down. So take a look at this. Right here on screen. This is the used vehicle index year over year. And look at that. I mean, this is generally where you sit, right around 0 to 5 on a read of these. And what you've got is this massive positive supply chain shortage-induced vehicle pricing. And now you're negative. But again, I mean, look at what you're coming after here. Like, at some point, it's just gonna make sense. So some folks here say hungover is an understatement. Other people say that volumes are low. I don't know if we're talking about the same things here. And here you go. A lot of green, though, going into the end of the year here. Almost 1% on Enphase. Nothing really standing out as a big runner other than maybe SunPower here moving after Neo. Other than those two following some excitement here. Intel not really moving that much either. This was up, 2.5% there pre-market. I think that that Israel deal, I don't know. I still think that was not as good as... Oh, look at Zim. It's now down 11%. I'm telling you, man. I told you. I think there's a short in there. I don't know how long that'll last or when it makes sense to actually execute on that. So anyway, look at probably at the open if I weren't streaming. But anyway, so we've got NVIDIA here coming up to a 493 resistance. Let's see how it moves here. We've got Trade Desk. Trade Desk I see down 47 bips. Nordic American. I don't know if this would be much of a proxy. Look at that. That actually started moving around the same time as Zim with the Red Sea drama. So maybe Nordic American might not be as much of a quick mover as well, but maybe that's another proxy trade. I'm trying to think, what's Maersk's ticker symbol? I gotta find the darn thing. So they are... I don't know if we can trade them. AMKBY. It's just listed as OTC. So very, very thin volumes over here on the Dutch company. Maybe not the best choice. Anyway, so here's Tesla. Tesla's giving up actually a little bit here. Look at that. Giant old red candlestick coming through on Tesla there. Down 64 bips. Or sorry, it's up. It's down to 58 basis points now. Mid 60s-ish. So a little bit of selling coming in there. Maybe a little bit of end-of-the-year profit-taking. Wouldn't be a surprise to see some end-of-the-year profit-taking, especially for funds holding these. Treasury curve to flatten today amid front-end supply hurdle forecasts on trying to get that 10-2 curve maybe eventually uninverted. Where do we sit right now in terms of inversion? Let's see how deep we are right now. Where do you find these live streams on YouTube? They're at Meet Kevin Market Open Lives. So yeah, we're negative 46.7 on the 10-2 inversion right now. So we're still inverted. Oh, it's Danish, not Dutch. My bad. Oh, you're right. Yeah, I mean, it literally says Denmark. My bad. So negative 46.7 on the 10-2. You know, we've been stuck in actually getting more inverted here since the rally began November 1st. It's a little bit of bond market doubt that the Fed's going to be able to stick it with a pretty soft landing. So not great. Not great to see that. 10-year yield right now still stuck at about 3.91. And oil up again, another 2.5% at 81 right now. Okay, so next up, what else do we have here? We have, let's see if we got any, no real breaking news right here. Nothing here. We do have S&P within a whisker of an all-time high. Really? I thought we already broke the SPY all-time high. Let's take a peek at that. Zoom out to the week chart. Yeah, I mean, to me, that looks like we've already hit an all-time high. Look at that. Yeah, we are, yeah, 465 was the SPY all-time over here. We're past that here. So I don't know, I guess when they say within a whisker of all-time high, it could mean either direction. But yeah, I mean, past it. Past that all-time high. So look at the Qs, pretty similar as well. Qs also above that all-time. Let's go to Apple. Apple's stuck at about 193, got rejected by 200. This is almost going to take a pretty big catalyst to push some of these stocks past their next breaks. You know, 500 Nvidia, 258 Tesla, 200 Apple. It's going to happen one of these days, but I don't know if, you know, are you going to need some kind of correction first? Who knows? So, what else? Well, stay tuned to eHack. We'll have some more updates on eHack coming throughout the day. We've got our course member live stream coming up here soon. We'll get into some analysis, some good old fundies again, so that'll be fun. Otherwise, it seems relatively benign right now. What else here? Financial Times headline, though. Banks shed 60,000 jobs. See, that doesn't sound that great. Global banks eliminated more than 60,000 jobs in 2023. I mean, we did have a banking crisis, in fairness. And it was a banking crisis that was bailed out, yes, but a banking crisis nonetheless that does call for stabilizing and maybe right-sizing a little bit. So I don't know that that's that big of a deal. And seeing some of these acquisitions we saw, like Credit Suisse by UBS, First Republic by JP Morgan. I don't know how big of a deal that is. Anyway, Tesla now up only about 30 basis points. I hear, yeah, coins about down 1.3. NASDAQ still trying to push, though. Yep, still up about 36 basis points. And Phase up about 1.6 as well. So pay attention to some of these numbers here. All right, with that, let's get ready for our course member live stream here. Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate and actively manage ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than HouseHack, nor am I presently acting as a market maker. Don't forget Short Casco is in there. Yeah, keep in mind that one of the sponsors on our channel is StreamYard, metkevin.com/StreamYard. They're what allow me to multi-stream to Twitter, Twitch, X, whatever you want to call it. If I wanted to, Instagram, Facebook as well. But anyway, I'm going to go make another cup of coffee. We're going to run into the course member live here. We'll be watching, look at NVIDIA though. NVIDIA at 495. Look at that. Wow, NVIDIA just broke above its Fibby there at the 493 level. Now it's really pushing here. That's pretty impressive. I wonder, could it be that right after Nancy Pelosi discloses her calls, that all of a sudden we end up getting some kind of rally? It wouldn't. I mean, it's not always true, but it tends to be pretty darn close frequently. Somehow she manages to pull that off pretty frequently. Geez, I wonder if it has to do with her day job. Nah, it couldn't. Anyway, all right, folks, we'll see you in the next one. Goodbye.